Hey guys, Jay here, smarthelping.com. Interesting, a new concept I have for content for financial models. So I'm going to try to, whenever I have time, take questions I get from customers that have bought templates and they have questions about a template, and I answer it. I'm going to try to make content out of that and explain. I think that'll help also give more context to these models and kind of, help answer questions that people might have about this the models, and I'll post the Q&As that of each product within the product itself as well. So today, happy Friday. We had somebody purchasing the gym financial model, and they had a question regarding leasehold improvements and how to account for that without, because they were worried about the tax effects of the gains because, well, so let's get into it. So we got the model here. We can configure the timing assumptions. The main thing though is capex. So this is a gym, but in this case they were tenants doing leasehold improvements. So they might put in just new things to benefit, new walls, plumbing, electrical. Leasehold improvements could be all sorts of things with all kinds of recovery periods or useful life, depreciation, all that stuff. But the thing is, so leasehold improvements are depreciable. I won't comment on the depreciation life of anything. You can look that up yourself, but I will show you how to account for it here properly. So typically, the row one is where you can use to do this, but you can do it in all these if you want to cost segregate with different depreciation lives of different things in the leasehold improvements, because you might be doing leasehold improvements for things that have 15-year life, 7-year life, 5, 10, whatever. Um, and there are some caveats to what the depreciable life of a leasehold improvement is, depending on, like, there's a lot of stuff that goes into it, so I'm not going to get deep into that. But in general, here's how you would account for just an arbitrary situation. So let's say you're doing leasehold improvements of, um, um, let's say $500,000. Okay, so you put 500,000. Here's your cost basis. Okay, I'm going to spend this much. Here's my improvements. I'm still leasing the building, so like to account for the lease cost, you could just account for that in the running costs, and you can adjust that each year, and it's a monthly amount, and you could define the start month for it. Here we got rent in this row, so you can account for that fine, but for the actual capex you're spending, that's not well. Again, there's a lot of accounting things, but generally that's going to have your for cash flow and for to model what the project is. You're going to want to know how much that is. So, we're putting, let's say there's initial $500,000 spend. We're doing it on January 1st, 2021. And you could pick any month, and that'll just adjust when the cash flows down here in the model. For CapEx, you can see there it is right here. And that will affect the timing of cash and the amount needed. And obviously, debt will offset that here. Um, It'll also be dependent on when you're starting revenue. That could affect cash flow a little bit as well, relative to when the leasehold improvements happen. Uh, if you can run operations for a little bit and then do it or whatever. Anyway, so the point is, you can put cost basis here, whatever your leasehold improvement is. The useful life, let's say 15 years or 10, or it doesn't matter. This is doing is affecting the income statement depreciation for the building row here. So you can see it's 8,333. Um, If we put a useful life of 20 years, it's going to be a lot less. Here now it's 2,000, and it'll go until the end. Now the thing is, in the model, you can pick any arbitrary end month to end. Let's say you only wanted to run a 5-year forecast, so 2021, 2, 3 to 2025. Okay, you wanted to end it there, and we do want to include the exit value. We're going to say maybe 20x. So we're going to sell this thing for $16 million, trailing 12-month EBITDA. What we're saying here is there's going to be some value, like when you sell the gym, the business, you don't own the building. So there's no real, like on leasehold improvements, and again, I don't want to get into financial advice, tax advice, but from what the question implied, there's not going to be a gain or loss happening on the leasehold improvements. It's just you have the capex spend, some useful life, and then at sale, you just want it to be a zero net gain or loss. All you have to do is take the book value at sale, which is just the total amount less the depreciation that you've taken. You're going to copy that, paste it right here. So what that does is now the value is exactly what the book value is, and there's no more net gain or loss, and that's it. And that's the way to account for that in this model. And what will happen now is if we look at the exit happening here in 60 months, that's where we configured it. There's no net gain or loss from sale of assets. And you could also do this for multiple types. You see here, let's say, I had a value above 500,000 or above the book value, let's say 390,000. Well, now technically there's a little bit of a gain because we've taken more depreciation. We've sold it for more than what we depreciated. So that $10,000 gain, in theory, then would go there. But for leasehold improvements, there is nothing like that. Don't quote me on that, but just the point of this is you can zero out the net gain or loss by entering the value at sale for the leasehold improvement at whatever the book value is, which is cost basis less depreciation. Now, you could also, if you wanted to segregate, you could put, 100,000 into here, maybe 200,000 into something else. You get a flooring, carpeting, all different things here. So you can separate that into maybe 15-year life, 5-year life, and that will affect, now you've got depreciation expense happening for a couple different items here. It doesn't affect the cash flow because you're still, well, I guess unless the timing of those expenses change, like here we have March, February, March. Let's put all these on the same month. So that's still, the timing, cash flow, it won't matter if you're doing different, putting them in different segregated buckets to depreciate at different levels. If some things depreciate faster than others, and you want to see like how that affects the net income. Now here's what you would have to do. So I would simply take these values, copy, paste values. Now yes, that does break the formulas in here because the formulas in H, except for row 12. Row 12 is hard-coded a value at sale, but these other ones are designed to take any amount less than 100% of this and apply it at a pro rata basis to these based on the book value at sale. So that's the high level way I just generally do it. But if you have a specific situation like this where you have leasehold improvements and you want to just manually define this value at sale, you can do that here. Now, if we did that and then put, let's say 95% going to extraordinary income, the other 5% going to capex, I'm actually curious what happens here. I believe it just won't be counted as income. Yeah, so 15.2 is all we see, which is just this amount. So if you were doing this hard-coded version for value at sale, and you didn't have anything else to account for depreciate for to apply this value to, then you'd also want to make sure this is 100%. So that's like your sales proceeds of the business, tax to extraordinary income, and then on capex, we're just saying the cost basis here for these leasehold improvements, the value at sale is equal to the book value at the sale month, so there's no net gain or loss. Now, whatever you enter in here won't mess up the balance sheet. It'll balance. You can see here we're still balanced in the end month, and that's fine. And that just says we're removing all of the asset value. We're zeroing that out, and then any gains or losses or no gains or losses flows through. Now, if we did, let's say we had a piece of equipment that can be sold at a possible gain or a loss that, let's say, has a 5-year life, and these are arbitrary numbers. I'm just trying to show you the point of it. Let's say we bought this here in April 2021 for $10,000. We've depreciated it down. It's now the book value is 500. If we said terminal value here is 95, it's going to allocate 800,000 to that. Well, actually, no, it's still kind of the pro rata here. So you got to be careful if you do break these formulas and put value at sale. Essentially, you manually have to put the value at sale you're doing here, and that needs to match up with whatever your terminal value is, like whatever is being applied to capex, you would have to manually put in here. But it is possible, and that's all you'd have to do is just column H needs to make sense for whatever you're doing. And The only reason why I say to hard code over it if you're doing leasehold improvements is to force a 0 net gain or loss. And if you had items that don't need to be zeroed out, then you want to, but you have items that do below the building row because you're cost segregating, then you need to make sure, like if you want 800,000 to go into that, you'd have to copy this and put it into there and apply to this manually. And you can see there, this would show up here in net gain or loss. And then you just have to make sure that that makes sense for what you're doing here, and you can adjust how much maybe you do 99.5, some number. And the whole point of this, usually most people will just zero this out. They'll put 100% here, not apply anything to capex, and then you might have something on the building one if you're actually buying the building and it's not leasehold improvements. But if you're doing leasehold improvements, you can just manually enter the value at sale equal to the book value, so it zeroes out the gain or loss. And that is, I guess that's it. I'm trying to think if there's any other caveats that would be relevant for this situation. I think that's it. But yeah, completely doable. So you can manipulate the model without much work. You don't have to mess with any formulas, and there you go. All right, guys, I'll see you on the next one. Check out smarthelping.com for more templates.